Okay, good afternoon and welcome back to our options education webinar series. Today, we're going to be talking about how to hedge your portfolio using options. I hope everyone had a great 4th of July. Welcome back. The summer is really summer session is kind of kicking in. Things are a little slow right now in the markets, but I think this is a really good time to talk about this specific topic. Especially with some of the geopolitical risks that we see in the markets, everything with the trade war rhetoric that we're seeing that goes into effect tomorrow. It's really interesting to see how that's going to affect the markets. Certainly something to be aware of, especially if you're invested in equities. We are in this late cycle earnings season where we're seeing that stocks that are beating their earnings estimates are not really outperforming, but the stocks that miss their earnings are really getting punished severely. And we're just entering another earnings season. I think that's going to be a key theme for this upcoming earnings season. So there's a lot of things to be thinking about in terms of downside risks going into the next quarter. And that's really why I want to bring this topic up now, so that hopefully we can prepare ourselves if we do see some kind of market correction. So today, what I really want to cover is for any of you that have concerns of a market correction, and what I mean by that is at least a 3 to 5% correction lower or greater. If you have any concerns of that over the next few months or a few quarters, but you want to remain invested in the markets. So this could be for a variety of reasons, either because you simply think the markets are going to continue going higher, or perhaps you have dividend paying stocks where you rely on the dividend. So you want to remain invested in those stocks, but you're concerned about a potential move lower, whether that's a small move lower or a large move lower, whether you think that's going to happen over 1 month or over 1 year. What I really want to do is take the time today to show you guys what are the best practices to efficiently hedge a portfolio. So if you want to remain invested, what should you be looking for? I want to go over what tools you should use to analyze a hedge, and then determine if that's a right fit for your portfolio. And if it is, what we really want to do is help you determine what strategy is best, because there's lots of different ways to hedge a portfolio. So we want to make sure that we cover best practices and the tools so that you become self-sufficient at the end of this webinar to do your own hedging analysis using options play. So that's my goal here, is to teach you guys some basic concepts and then show you some real examples using options play so that you can go off and be self-sufficient in being able to analyze a hedge for your own portfolio. So just a quick introduction. My name is Tony Zhang. I am the chief strategist here at Options Play. I am the one that does all these webinars every single week. So welcome back to our first one in July. I hope everyone had a great 4th of July and ready to get back into trading in the summer sessions. So before I get started here, I just want to launch a quick poll. I just want to get a feel for who's in the room and what people are thinking in terms of the market. So are you concerned about a market correction greater than 3 to 5% over the next few months? Just answer yes or no to this simple question so that I can get a feel for who's in the room. And then we'll kind of tailor our discussion today around that. So far, about 80% of you are concerned about a correction of 3 to 5% over the next few months, and about less than 20% of you think the markets will continue going higher. And that's okay. It doesn't matter what your views are, whether you think the markets are going higher or lower. The key thing about this specific webinar is you can take these concepts and apply it whenever you do think that there's a correction coming. So even if you don't think the correction is coming now and you think it might be coming 6 months or a year later, I hope the concepts that you learned here today will be useful when that does happen. So just to share the results, overwhelming 83% of you are concerned about a correction, about 17% of you are not. Okay, so that's great. That's a good start, because that allows to put us into the context of this conversation about how do you actually protect yourself of one of these corrections if it does materialize, and what should you be using, or what instruments should you be using in order to hedge your portfolio. That's what we're going to go over in details today. So this webinar is recorded so that you guys will receive the recording about 30 minutes after we're done here today. I will also have the slides for you guys And I highly recommend, if you're trying to do a hedge in your portfolio for the first time, please take the time to go through the webinar again, watch the recording, use the slides. There's a lot of things that I'm going to be talking about that maybe you might not be able to memorize just by watching the webinar once. So I highly recommend you to come back, look at the slides, look at what the best practices are, and then look through the examples that we show you so that you can do these analysis for a hedge on your portfolio by yourself. I'm going to assume certain things on today's webinar that you might want to change those assumptions when you're making those analytics on your own account. So please download the slides as well, because I have some great links. A lot of people ask us, how do I get to the other webinar recordings, or how do I get access to, the daily trading ideas that we send? So I have those links in those slides. So please download them after you're done so that you have those links for yourself. You can review all of our previous webinars and all of the other webinar topics just by clicking on these links. So let's go ahead and get started and talk about what we're actually going to go over here today. So simply, the top 3 things we're going to go over is what is a portfolio hedge for those of you that have never done this before, who uses a portfolio hedge, or why you should consider using it, and then lastly, how do you actually efficiently hedge your portfolio? So what are the techniques to utilize options with to be able to create an efficient hedge for your portfolio? And that's the key here, is because there's lots of different ways of hedging. There are expensive ones, there's cheap ones, but how do you most efficiently do that? And a lot of times, people are looking for cheap hedges, and what I tend to find is that the cheap hedges may not provide the type of protection that you want. So I want to talk about providing the right protection for what you're looking for, and that's more important than the cost to the hedge. And then lastly, we'll talk a little bit about what are the best practices in terms of what you should look for when you're hedging, and then actually showing you some real examples with some real portfolios to show you the actual numbers behind why we're telling you to do the things that we're telling you to do. So hopefully that will kind of put everything into context for you so that you can start analyzing your own portfolios and deciding whether if a hedge is suitable for you. So let's just talk about what is a portfolio hedge. Very simply, it's very simple. We take your existing stock portfolio that you have today, whether you have stocks or ETFs, that we consider that your stock portfolio. As you can see through the picture, a stock portfolio has dollar for dollar gains and losses. So for every dollar the markets go higher, you make $1. For every dollar the markets go down, you lose $1 for every share that you have. And it's equal on both sides. What we're doing in conjunction to your stock portfolio is we're buying a put on an index or an ETF that tracks your portfolio. And we'll talk a little bit about that in 1 second, but it's a very simple put strategy. You're buying a put for the portfolio that you own, and the resulting trade that you have is a hedge portfolio that gives you the same upside. So if the markets continue going higher, you will still participate in that gain. However, if the markets trade lower, you have limited losses. And that's the goal here, is to limit the losses to your portfolio if the markets goes lower. Okay, so that's really what a portfolio hedge is. It's really simple. You're taking your stock portfolio, you're adding a put or a put spread to it, and that gives you your hedge portfolio. That's what we're going to analyze today. So who uses portfolio hedging? So this is really the key part before we move on to understanding do you fit into this category? Because if you don't, then maybe this is not the right webinar for you. Okay, so anyone who's interested in using a portfolio is someone who's invested in a portfolio of stocks or ETFs. You're looking for protection against a correction that's at least 3 to 5% or greater. And the key part here is that you do not wish to sell any of your holdings, or do not wish to sell all of your holdings. And the key to this is because if you're okay with selling your holdings and sitting in cash, then that is always by far the best portfolio hedge. There's no better hedge than simply sitting in cash and waiting until you feel the markets are going to recover. However, not everyone has that luxury. Not everyone has the ability to sell their stock because it might generate a tax bill, short-term capital gains, or perhaps you simply rely on the dividends for income. So you don't have that same luxury of simply selling your positions and sitting in cash. If that's who you are, then portfolio hedging is something that you should look into. Okay. Now there are some limitations to portfolio hedges. It creates an imperfect partial hedge. meaning this type of strategy is not going to give you a dollar for dollar perfect hedge. It's a key thing to understand. However, it is a relatively cheap way to hedge your portfolio, but it does provide an imperfect partial hedge. It does add additional drag to your portfolio, meaning portfolio hedging is not free. So if you're going to purchase protection, it's going to cost you something, and that cost will produce some type of drag to your portfolio's performance. And lastly, portfolios will underperform from constant hedging. So hedging is not something you want to do all the time. It's only something you want to do in very select times when you feel that the markets are about to crash, or if you feel the markets are going to turn lower. You want to enter and exit a hedge as quickly as possible, because you want to reduce the cost of a hedge by reducing the amount of time that you're inside a hedge. Okay, so with that all in mind, what I do is I have one other question that I'd like to ask everyone here. I just want to get a feel for 83% of you answered that you are concerned about a hedge. So during a market you're concerned about a market correction. So during a market correction, what would you actually do? What would you currently do? I just want to get a feel for what people are currently doing when they feel that the markets are about to correct. So do you sell your holdings and sit in cash? Do you remain invested and have a hedge on, or you're not sure what to do? So far the polls here are fairly even. About a third of you have said you sell your holdings and sit in cash. Half of you say you remain invested, but you want to have a hedge on. And about 20% of you said, I'm not sure, which is great. This is the type of consensus that we typically see, is that people want to have a hedge, but many people don't know exactly how to go about hedging, which is fine. So a lot of people end up sitting in cash. And then for those of you that don't know, that's exactly what this webinar is for, is that we want to show you how to go about doing this, so you know exactly how to go about hedging your portfolio and you're not unsure of what to do, okay? So here's just the results. Like I said, 27% of you sit in cash, 53% of you would like to have a hedge, and 20% of you say, I'm not sure. So for those of you that are not sitting in cash, this webinar is designed for you to show you exactly how to go about hedging your portfolio. So let's go ahead and move on here. So now let's talk about how to efficiently hedge your portfolio. Like I said, the best way to hedge your portfolio is to sit in cash. If you have that luxury, you should always do that. But if you don't have that luxury, what should you do? So the strategy here is a relatively simple strategy. Like I said in the first slide, what we're doing is we're buying puts or put spreads. So what we're doing is we're buying either a put option or a vertical, for those of you that are a bit more advanced, and you do it on an ETF or an index option. And the reason we do this is because ETFs or index options typically track a broad-based portfolio relatively well. And this could be ETFs like SPY, QQQ, IWM, which is the small cap ETF, or perhaps a specific sector. So for example, if you have a very tech-heavy portfolio, or a healthcare-heavy portfolio, or whatever or financials heavy portfolio, perhaps you work in that industry and you invest mostly in those types of stocks, you generally want to find some kind of ETF or index that tracks your portfolio the best. So if you don't have a very focused portfolio and you just have a broad-based portfolio, you want to use either SPY, QQQ, or IWM, any of these broad-based ETFs. Or if you have a specific focus, then you might want to use one of the sector ETFs to help you hedge. But the idea is to simply buy a put or a put spread on one of these ETFs that tracks your portfolio. Now, when you're buying a put, there's really two things that you need to think about: is what expiration do you choose and what strike price do you use. So with respect to expirations, we usually tell users to use at least 1 to 2 months beyond your time horizon. So if you expect the market correction to happen over the next 2 months, you want to use a 3 or 4 month option. If you think a big correction is coming and you think it's going to move 10–15% over the next 6 months, then you might want to use a 6 to 9 month option. So you always want to go a few months beyond your time horizon. And I always tell users you shouldn't hedge with anything less than 2 to 3 months out. you certainly don't want to hedge your portfolio with a 1 month option. And this is really comes down to time decay. So when we talk about hedging your portfolio efficiently, what we want to do is to be able to provide you with downside protection without paying a lot of time decay. And the only way to do that is by buying relatively longer dated options. So at least 2 to 3 months out, if not further, that minimizes your time decay factor of your hedge. And that really allows you to hedge relatively efficiently. When it comes to strike prices, you really have two choices here. You can do an aggressive hedge by buying in the money puts, which are more expensive, or you can do a conservative hedge by buying out of the money puts, which are cheaper. Now, both scenarios provide some form of protection. Obviously, one is more expensive, that gives you better protection. One is cheaper, that gives you less protection. You can think of it as like when you're buying health insurance, you can buy the expensive protection, that expensive insurance that covers everything, or you can buy the cheap insurance that covers just the basics. This is really where my personal preferences, and based on what we will show you in a few minutes using options play, is that we generally find that the more aggressive hedge, the more expensive hedge, generally gives you a more efficient hedge. And I'll give you some real examples to show you why. But at the end of the day, it's your choice whether you want to buy the more expensive or cheaper insurance against your portfolio. Like I said, based on our research, based on what we're about to show you, we generally find that the expensive insurance, even though it costs more, gives you a much better hedge to your portfolio. And we'll show you that in a little bit. Lastly, when it comes to buying puts, the last thing you need to determine is how many contracts do you need to buy. So this is where we're going to show you how to use the contract calculator on options play to determine what is the right number of contracts to purchase for your hedge. It's actually really simple. Our calculator does all of that for you. So what are some of the best practices? And when you think about hedging best practices, it really comes down to minimizing costs. And the reason for this is because hedging is expensive. If you're hedging all the time, you're going to underperform your portfolio. So it's really important to understand how can you hedge your portfolio while minimizing that cost. So the biggest thing working against you when you're hedging is time decay. Time decay is always working against you. So in order to minimize time decay, there's a few things that you can do. Number one, you want to enter and exit very quickly, meaning you want to enter the hedge when you expect the beginning of the correction. You don't want to enter early. You don't want to anticipate a corrections and then put on a hedge in advance of that. You only want to start that hedge when you feel the markets are starting to turn lower. And in this particular case, I always think it's a little better to be slightly late to the party than to be too early, because you're going to be paying that time decay, and that's really going to hurt you with the hedge. On an exit strategy with your hedge, you want to exit with the expected market bottom. So if you think the markets are bottoming, and there's lots of different indicators you can look at for this type of thing, like you can look at VIX or any of the other type of fear indices that will give you an idea as far as when the market may have bottomed, or if the market simply just rallies, meaning the correction never happens. You want to exit that hedge as quickly as possible. So you want to minimize the amount of time you're actually in a hedge to minimize time decay. The second thing you can do to minimize your cost is to sell cover calls against the portfolios that you own to offset the cost of the hedge. So you can sell cover calls, which basically, when you think the markets are correcting or moving lower, selling cover calls is a great way to basically give up market upside, which you don't think is going to happen anyway, and take those premiums to help pay for the cost of the hedge. And sometimes you can reduce the cost of your hedge by 30 to 50% by selling cover calls, and I'll show you some examples of that. Another thing you can use is index options as opposed to ETFs. Index options have preferred tax treatments. So most hedges will last less than 12 months. So the profits that you gain from your hedge is taxed with short-term capital gains if you're in a taxable account. So if you're trading ETFs, you have to pay the full short-term capital gains on that. If you're trading index options like SPX or NDX, or NQX with the new lower value NASDAQ 100 index options, you actually only pay 60% short-term capital gains and 40% long-term capital gains. So it gives you a slightly better tax rate for the profits that you receive on your hedge. So that's another way that you can consider reducing the cost of your hedge. And lastly, when you're using hedges, you want to make sure that you use the correct instrument. So this again is not by any means an exhaustive list. This is more for this is just more for illustrative purposes. If you have a relatively diversified, broad portfolio, you want to use instruments like SPX, SPY, IWM, these broad-based indices that will track your portfolio and give you the best possible hedge. If let's say you have a tech-focused portfolio, which many of you do, you might want to choose one of the indices that track technology like NASDAQ 100, the QQQs, XLK. Any of these types of tech-based indices will be a better hedge for your portfolio if you have a tech-heavy portfolio. Conversely, for those of you that are mostly in bonds and maybe you don't have a lot of stocks in your account, you want to use a bond portfolio or bond ETF like BND, TLT, or LQD. These types of ETFs that track the bond indices or bond markets will provide you with a better hedge. So these are all different instruments that you can use. Make sure that you select the one that most suits you. So let's actually take a look at some real examples, because that's how we're actually going to be able to learn how to hedge your portfolio, and going through some real examples, because that's going to help wrap your head around some of these things. So first off, what I want to do is show everyone Options Play. For those of you that have never used it, welcome. This is the tool that's designed to help make your options trading as easy as possible. And the best way to kind of understand this platform and think about it is by first looking at something like the chains. Any of you that have ever traded options are familiar with these types of pages. It lists out every single strike price, calls on the left, puts on the right, and it's got a lot of data and a lot of numbers. And we tend to find that people tend to get a little confused by some of these numbers sometimes. There's a lot of things on your screen, and sometimes you're not sure exactly what to pick. And even if you know how to navigate these types of pages, like I've learned how to navigate these like the back of my hand, a lot of the things that you need to do to analyze one strike versus another, you can't do straight from the chains. You have to input these numbers into some other tool to give you that type of analytics. And that's really why we created Options Plays. We wanted to give you a brand new way to look at the chains so that you have all those analytics at your fingertips before you start looking at a chain, so that you can actually start playing around with different strategies and analyzing them and see how they would perform. And that's really what I'll be showing you guys here today. So the platform itself is divided into 3 sections. We have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. So these 3 panels, we call it the what, the why, and the how of options trading. So every day you log in, you want to know what symbols should I look at. We have fresh trade ideas for bullish and bearish ideas scanned for you. You have your own watch list, so we have pre-built watch lists for you, and you can create your own so that you can always stay on top of the stocks that you want to take a look at. Our security analysis panel is designed to give you quick snapshot data of what's going on with the underlying stocks, so you can quickly see what the current trends are. Things like earnings, dividends, and price action data with support and resistance levels right here on your screen. And then lastly, trading and income, meaning once you have a view on your stock or ETF, how do you actually take advantage of a bullish, bearish, or even an income trade on that specific stock? So today we're going to focus on how to utilize this tool to help you determine whether or not you want to hedge your portfolio. So right now I have SPY up just because it's simply the most popular broad-based indice that you can trade. I'm going to use this as an example for illustrative purposes to show you guys how to go about doing this. So what I'm going to first do is I'm going to look at a portfolio, and I'm going to show you some different hedges to give you an idea as far as what the difference is between buying a cheap hedge versus an expensive hedge, and show you, as the markets go lower, what your expectations are, so that you can do these analysis on your own based on your own assumptions as to where you think the markets are going to go and the size of your portfolio, so that you can determine exactly how you want to hedge your portfolio. So first off, what I'm going to do is I'm going to first modify these puts that we're going to buy. Like I said, when you're buying a put on or when you're buying a hedge on a portfolio, there's only 2 things you need to look out for: is what expiration date and what strike price. And if you remember what I said before, is that you want to always use an expiration date that's at least 1 to 2 months beyond your time horizon. So I'm just looking at SPY right now, and you may may not agree with my analysis here, but this currently looks like a bit of a head and shoulders formation. You got a left shoulder here, head formation here, and I'm starting to form that right shoulder. So I don't think it's that crazy for it to break below this 269 neckline and then shoot all the way back down to maybe 260 or even a little lower, maybe to this 255 level within the next couple of months. It took about 2 months to reach this top. And I think that it's not that crazy for it to reach that maybe by mid-August, September. So with that kind of time frame, I'm typically looking at October expirations as my expiration date. So I'm going to modify these two puts here on the right to an October expiration. And again, you can choose the expiration that fits your time frame. Just again, reminder, you want to use an expiration that's about 1 to 2 months beyond your expected time frame. And what I'm going to do is I'm going to say SPY is at 273 right now. So I'm going to look at two options. I'm going to look at the expensive hedge, so the hedge that's in the money. And then I'm also going to look at a hedge that's out of the money, the cheaper hedge. So just so you guys have an illustrative look at both sides as to what they actually mean to each other. And then here, what I'm going to have is I'm going to have the portfolio that I currently own. So you can think of this as my current portfolio. This is my hedge. These are my two possible options for hedging. So let's go about analyzing it. Now, before I do, the only third thing that we need to think about is how many contracts do you want to purchase to do your hedge? And we have a risk and investment calculated just for you to do that. So what you want to do is you want to enter the amount that you currently have invested in the market. So let's say you have a $500,000 portfolio. You can say that I want to invest $500,000. And what this does is it instantly creates effectively a $500,000 portfolio here on the left-hand side. And it provides you with the two options of your hedge. So right now we have a $500,000 portfolio here on the left-hand side. And as you can see, what I have is two puts. I have the October 19th 268 put, which is about $5 below the current price, so an out of the money put. And then I have the same October 19th 277 put, about $5 above the current price. Let's actually make this 278, so it's exactly $5. So I have one put that's $5 below the current price, and I have a put that's $5 above the current price. As you can see, one costs a little bit more than the other. One costs $11,000, which is roughly 2% of your portfolio. So you can think of this as buying insurance that costs you 2% of your portfolio. And then you have this other one that's about $17,000, which is around 3.5% of your portfolio. So one costs about 2%, one costs about 3.5%. So let's actually take a look at how these hedges will perform in the different market conditions so that you can determine which one's best suited for you. Okay, and that's what we're going to use our P&L simulator for. This is by far the tool that we use the most for all of our webinars, and is the one that we're going to use today to help you quickly decipher exactly which strategy is best suited for you. So what I'm going to first start off with is a scenario of what happens if the market doesn't do anything. What happens if it just stays exactly where it is by October, meaning it doesn't go higher, it doesn't go lower. What actually happens? So I'm going to first start with that as my starting point. So here's my portfolio on the left. If the market goes nowhere, I make $0. I don't make any money. I don't lose any money. What happens to my two hedges? As you can see on the cheaper hedge, I'm actually losing $11,000 because I'm buying an out of the money put. Every single dollar that I'm paying for is extrinsic value or time value, and I lose all of that if the market doesn't move significantly lower. So I'm actually going to lose $11,000 if I bought the cheaper hedge. If I had bought the more expensive hedge, I actually lose less money. I only lose $8,600. So again, even though so right off the bat, even if the market doesn't go anywhere the way I expect it to, even though the more expensive hedge costs me more money, I actually end up losing the least amount of money if the market actually goes absolutely nowhere. So that's number one, why we actually always encourage users that are trying to provide a hedge is to go for the more expensive option because it provides you with better protection in a lot of different scenarios. And I'm going to cover some of those scenarios in a second. But just right off the bat, if the market goes nowhere, even though it costs me more money, because I'm buying it in the money put, not all that money is going towards extrinsic value. So that option has some intrinsic value. And that is worth something to you if the market doesn't really happen, doesn't move in the direction that you expect it to. The other thing I want to also consider is what happens if the market stays where it is, but over a short period of time. So as you can see, let's say between now and August, the market doesn't really go anywhere. As you can see, if I had bought this out of the money cheaper hedge, I'd lose about $4,500 because most of that is going to time value. And that is what's working against you when you're buying a hedge. Versus if I bought the more expensive hedge, I'm actually only losing $1,500. So again, the more expensive hedge gives you much better protection because if the market doesn't go anywhere, you're not losing that much money. Only in the cheap hedge are you actually going to be losing more money if the market doesn't go anywhere. So let's look at a few other scenarios. Let's say what happens if the market starts moving a little lower. So let's say the market moves down to 267, just $5 lower. Here, as you can see, my portfolio is now down about $11,000 because the markets move lower, so I'm going to lose money on my portfolio. So now let's take a look at how much money am I going to make back on the hedge. So as you can see, if the market moves slightly lower over the next couple of months, here I'm only making $330 on the hedge, very, very little. So that offsets almost none of my losses on the portfolio. Versus the more expensive hedge gives me a $6,000 profit. So I've hedged almost half of the losses that I have, more than half of the losses that I have in my portfolio. So again, this is where I think this extra few $1,000s that you'll spend on a hedge is an extremely more efficient hedge for you, even though it costs you a little bit more, because if the market goes even remotely in your favor, you're going to get a much better hedge on the slightly more expensive option, okay? Now, let's say what happens if the market continues moving lower. So if the market moves down, let's say 5% to 260, then here I'm losing $23,000 or 5% of my portfolio. Here, as you can see, this cheaper hedge is now starting to provide some better protections, right? So now it's giving me an $8,000 profit out of the $24,000 loss. So about a third of the losses that I have will be recovered based on with the cheaper hedge. And here I get a $16,000 profit. So more than 2/3 of the losses that I have here will be offset with the hedge that I have here. So that, again, that extra few $1,000s is now providing a lot better protection for my portfolio. Again, the key here is not necessarily what's the cheapest way to hedge, but what's the most efficient way to hedge to provide you with actual protection in many different scenarios, not just in one or two scenarios. Because for this cheaper hedge to perform, you really needs to move significantly lower in a short period of time before these types of hedges really make sense. So if you expect a really quick, fast move, then the cheap protection may be worth, will provide you with enough protection. But for the most part, spending just a few $1,000s more or a few percentage points more, usually just 1 percentage point more for your portfolio, does provide you with a much, much more efficient hedge, in my opinion. So as you can see here, if the market moves down significantly, before I had talked about maybe moving down to 255. So let's say I think the market's going to move down to 255. Maybe it takes a little longer to do that. Maybe it does that by mid-September. So let's say it happens by mid-September. Here, I've lost $32,000 on my portfolio. That's a pretty substantial hit to my portfolio if the market does trade back down to 255. If I had bought the cheaper hedge, I do make a decent hedge of $13,000 out of the $32,000 loss. So I'm still in the hole about $20,000. Versus if I bought the more expensive hedge that cost me $5,000 more, I make $24,000 of the $32,000 back. So I'm only down in the hole about $8,000 as opposed to $20,000. So again, this is where spending a couple extra $1,000 here on the right-hand side may provide you with a much more efficient hedge if the market is to correct lower. So a lot of people tend to go for the cheaper hedge, but again, I recommend you to take a look at a slightly in-the-money option to provide a much better hedge. But like you said, different scenarios for different people. So you have to use the scenarios that you have in your mind to understand exactly what's best for you. And lastly, if let's say we're completely wrong and the market trades higher, as you can see, if the market goes up to 280, which is where it just was a few days ago, here, let's say by October 19th, which is the expiration date, the market moves a little higher to 280. Here, I make $12,000 in my portfolio. On the cheaper hedge, I lose $11,000. So I'm up about $1,000 on the trade. If I traded the more expensive hedge, then this is where I'm losing about $5,000. The difference between 12,000 and 18,000 is about 5,000, and that's where I'm going to lose. This is one of the scenarios where you actually lose money on the more expensive hedge. But my thoughts is that if the market did move higher between now and October, you probably would have cut your hedges regardless of whether you went for the cheaper or expensive one by that time. Meaning, if you don't really get this move happening below this 268 level and you really see the market starting to move lower and it kind of just trades sideways, you probably want to pull the plug on this hedge well before October anyway. So that's where you can kind of see what happens is that if, let's say, by mid-August, the markets are moving a little higher, you want to pull your plug anyway. And as you can see here, even though this hedge costs more money, you lose the same amount of money if, let's say, halfway through between now and expiration, the markets move higher. Here you lose $7,000. Here you also lose $7,000. So you're actually losing roughly the same amount of money, even though you're paying more for this more expensive insurance. And if the market starts to move in your favor, meaning if the market starts moving lower, you actually get a much better hedge with a slightly more expensive option. So again, that's why I advocate for users that are looking for an efficient hedge in their portfolios to look at buying a put option that's about 1 to 2 months out beyond your time horizon. I usually recommend at least 3 months out, because options that are 3 months or longer generally have much smaller time decay. So you want to minimize that time decay factor. And you can always have the choice between buying a cheap hedge versus a more expensive hedge. I always advocate going for the slightly more expensive hedge, because if it doesn't work out, you generally lose about the same amount of money as the cheaper hedge. But if it does work out, you get a much more efficient hedge with the slightly in the money put when you're using these types of strategies for your portfolio. Now, I can just do this real quick for another scenario. So let's say you have a tech portfolio. A lot of people have these tech-heavy portfolios, and I think this is one of the sectors that are most sensitive to potentially one of these trade wars that we're talking about. It's been the sector that has the largest losses whenever we see trade wars dominate the headlines. So especially with the potential tariffs going into effect at midnight tonight. What the long-term ramifications for that is and what China may do in response to that. These are all risks to potentially protect yourself, but also it's possible that nothing happens. It's possible that the markets continue going higher. So a lot of people want to remain invested in this specific sector. It is one of the hottest sectors. A lot of the performance in the S&P 500 comes from this sector over the last year. So a lot of people want to remain invested in this portfolio. So let's take a look at this for a tech-heavy portfolio. So what I have here is, let's say you own the tech portfolio. Let's take a look at maybe looking at a September, buying September puts. Because perhaps you don't expect this thing to draw out. You expect that the moves to happen relatively quickly. So let's also look at an in-the-money call. Let's say a put versus, let's say, an out-of-the-money put, a cheaper put to trade against that. And again, let's say we have a $200,000 tech portfolio. So here I have a $2,000 tech portfolio here on the left, and I have two hedges here. I have one that cost me $4,300 and one that cost me $10,000. So $4,300 is about 2%, a little over 2%. $10,000 is almost 4%. So quite an expensive hedge from a portfolio perspective. 4% of your portfolio is a decent amount. So let's take a look at these hedges and how they perform. So again, if the market goes absolutely nowhere, here I expect roughly no losses on my portfolio. If I bought the cheaper hedge, I'm losing $4,300. So this is where the cheaper hedge doesn't really pay off. It doesn't really go anywhere. Here, even though this cost me $10,000, I'm actually losing less money on this hedge. So we usually think about buying puts as, the amount of premium that you're paying is what you're risking. And that's absolutely right. But in this case, if the market doesn't really go anywhere, I actually lose substantially less, because most of the premium that I'm paying is not extrinsic value, it's intrinsic value that stays if the market doesn't go anywhere. And again, that's why the in the money put gives you a more efficient hedge. Now, if let's say the market starts to move a little lower, let's say if the market moves 5% lower here, as you can see, the cheaper hedge doesn't actually even provide you with any protection. It actually provides you with losses. So here you lose $10,000 on your portfolio. With the cheaper hedge, you're going to lose an additional $1,500 versus this more expensive hedge will give you a $6,300 profit, which offsets your $10,000 loss. So you're only losing about $4,000 as opposed to $11,500 if you bought the cheaper hedge. And obviously, if the market continues to move lower, this trade gives you a much better hedge. So here you're losing $26,000 if the market goes 13% lower, but you make 22 of that $26,000 back. So you're only down about $4,000 versus this cheaper hedge will only provide you with a $14,000 gain. So you lose about another $12,000 with the cheaper hedge. And then if the market moves higher, you can use this P&L simulator to quickly see exactly what your expected losses are, and whether you think that the move will happen over a short period of time, or if you think the move will happen over a longer period of time. This tool really allows you to create all different types of scenarios and see what your hedge will provide you with in terms of losses on your portfolio versus how much gains that you'll actually have from your hedge. So this really allows you to play around with different expiration dates, different strike prices, and create the different scenarios that you think is going to happen in the markets to say exactly what my worst case scenario is and what my best case scenario is. I'm looking at tech right now and I see that same head and shoulders pattern here. We see this huge resistance level around 70, 71, broke above it, but it really couldn't sustain that move for very long and came back down. And I really see this neckline around $68, $69 as a potential move lower. And I don't know what's going to move lower, but certainly some of the trade wars are a potential catalyst. And these are all things that are in the back of my mind as in my portfolio, I'm still fully invested because, again, I do think that there's still a possibility for this market to continue higher, but I'm always aware of the potential risks. And I think that it's not crazy for technology to go back down to 65 or 64 over the next few months. So I can certainly put those targets in my scenarios and say, if I think the markets are going to move lower, how much hedge am I going to get versus each different, if I buy September out of the money put versus in the money put, what are my different scenarios? And you can try out all different ones and see which one's best suited for you. But again, based on our research and based on what we've seen here today and what we've shown you here today, we've generally found that buying a slightly in the money put, which costs more money, will give you a much more efficient hedge. So I just want to wrap up with one last thing to talk about how do you actually further reduce the cost of these hedges by perhaps selling some cover calls against it. So as you can see here, I can buy 28 puts right now, or I have to buy 28 put contracts to efficiently hedge my portfolio. So one of the things I can do here is, as you can see, this costs $10,000. So about 4% of the underlying, almost 5% of the underlying portfolio to buy this hedge. So that's actually quite expensive in hedging terms. Usually hedges cost 2, 3%. 5% is quite a bit to give up of your portfolio to buy a hedge. But as you can see, I generally find that they are worth that, if you will. But one way that you can further reduce the cost of your trade is you can actually write some cover calls against it. So let's say you can sell 28 contracts of cover calls against that. What you can do is you can recuperate $336 in income over the next 22 days. So over the next, let's say 3 months or so that you're buying a hedge for, you can maybe sell this 3 to 4 times and recoup around $1,200, $1,500 back in terms of income that you receive, so that you can offset that $10,000 by an additional 10, 15, sometimes 20% if you're selling something in a higher that has higher volatility. You can reduce that cost of that hedge by selling cover calls against it, because you're selling calls that you think the market's not going to hit anyway. So you're selling a 72.5 call, and basically that's the all-time high here. So if you're concerned about a correction, you're certainly generally not concerned about the market going back to that 52-week high. This allows you to generate some income by selling calls against that, and it allows you to basically help pay for that hedge by selling some upside calls against that. That is one of the best ways to potentially reduce the cost of buying an insurance on your portfolio for a hedge. So with that, I just want to wrap up real quick. Again, just want to go over a few different things. If you're thinking about a hedge, again, this is really for those of you that do not wish to sell any of your holdings or all of your holdings. If you have that luxury, please don't use options to hedge your portfolio. Just move a portion or all of your portion of your portfolio into cash. That is by far the most efficient way to hedge. But if you can't sell all your holdings or some of your holdings, options is a way to potentially hedge your portfolio. The best way to do that is always a longer dated expiration, at least 1 to 2 months beyond the time horizon that you expect a correction to happen. I usually recommend going at least 3 months or further to reduce time decay. In terms of strike prices, you can choose in the money, which are more expensive, versus out of the money, which are cheaper. I hope that based on the examples that I showed you guys today, I've explained why I think the expensive hedges generally do give you a more efficient hedge and a better hedge, because even if the market doesn't go in your favor, or if it does go in your favor, you generally come out better with the more expensive hedge versus the cheaper hedge. And then lastly, to calculate the number of contracts, use our calculator. It will do all of that work for you, so you don't have to figure out exactly how many contracts to do, because that's actually one of the biggest challenges to hedging, is understanding how much to hedge. Our calculator actually does all of that for you. So lastly, always make sure that you minimize the time that you're in a hedge by making sure you enter when the correction actually starts, and exiting if you think the markets are bottoming, or if simply the correction never happens, exit as quickly as possible. That will help reduce the time that you're in that hedge, which will reduce the cost of the hedge. And then you can always sell cover calls against your hedge in order to pay for it. And lastly, for those of you that have never traded index options, this might be a reason to consider taking a look at that, because of that preferred tax treatment that I just said before. So if you're in a taxable account, hedges usually don't last very long, so you have to pay short-term capital gains on those gains. One way to reduce that tax bill is by using index options, because you have a lower tax bill with those types of options. So with that, I just want to thank everyone for taking the time out this afternoon. What I'm going to do right now is I'm going to open this up for Q&A. So if you have any questions regarding any of the things that I just spoke about, please type them into the chat window or use the Q&A, and I'll be able to answer any questions you guys have. Elizabeth's asking, on this tool, it shows a percentage of volatility. Can you please talk about volatility and how to use it? Sure, absolutely. So that's a little bit more advanced topic, but I'm happy to cover this. Essentially what we're doing here, I'll set this up real quick again so let's see, we have buying the shares, we'll buy a put, we'll buy a slightly longer dated put. We're looking at technology here. So let's look at buying some puts. Same thing, September. So I have a 70, maybe 73 put versus a 69 put. And the question was this volatility slider. So like I said, if we think the market's going to head lower, the one thing that you can also add to this is that usually when markets head lower, volatility will expand. And if markets move higher, volatility usually contracts. So you can use this to determine exactly a more accurate profit or loss example here. I usually tell users, if you're brand new to options trading, you can leave this alone. It's okay to leave it alone. And the reason is because even though changes in volatility does affect your option pricing, as you can see here, it usually doesn't affect it to enough of a magnitude to really make a huge difference in your choices. So as you can see, when the volatility goes from 16% to 20%, which is a huge jump from a percentage standpoint, your jump in returns is actually relatively minimal. We go from 155% return to 163% return. So only an 8% gain over a or 8% gain, which from a percentage standpoint is even lower. So this is about maybe a 5% increase in profits. So very small, fairly minimal impact to your returns. So you can use it for those of you that are a bit more advanced to get slightly more accurate hedges. But this is really designed so that you can get more accurate. But like I said, it's not critical, because the changes to your percentage gains and losses is usually relatively small percentage. I have a question here. Is this a function of bear put spreads versus put, the former being a better hedge and better economics? Um, yeah, so we're talking about in the money versus out of the money. You could certainly also use a spread. The reason that spreads are not as popular with hedges is because spreads does have a limited losses, or I'm sorry, it limits your potential return on the hedge. And usually, when we're hedging, we usually expect perhaps a larger than expected move. So the put really allows you to provide as much exposure as possible to the downside to provide you with that protection. With the spread, you just don't usually get as enough of a protection. So you can use a spread, and you can use this tool to analyze using a spread. And this is really the power of this tool, so that you can put any two strategies side by side and compare a spread to a buying a put. But I generally recommend buying an in the money put. That generally gives you a much better hedge. Tom's asking for mentioning that go to cash is a desirable choice. Yeah. So again, I do. One of the feedbacks that I got the last time I did this webinar was, why don't you talk about going to cash? And I absolutely did, but I think I just didn't perhaps stress it enough last time. Is again, if you own a bunch of stocks and you think the markets are going to correct, and you don't mind selling those stocks and sitting in cash, that is by far the most efficient hedge, because it costs you nothing or virtually nothing, just some transaction costs to move it into cash. And then you can get back invested once you think the markets are going to come back. And it doesn't cost you virtually anywhere near the 2 to 5% that it may cost you to hedge your portfolio. Hedging is only for those of you that have stocks, but you want to remain in those stocks, but you're concerned about a correction. So that's really when you want to utilize these types of hedges. And many of you, maybe for whatever reason, want to remain invested. I personally want to remain invested because I think there's still upside in this market. I think the economy is strong. I think corporate profits look strong. There's still upside to this market, but I do at the same time see a lot of downside risks that I can't control. I can't control the trade wars. I can't control North Korea. I can't control a lot of the geopolitical risks that are currently out there that may cause some downside risks to my portfolio. And that is why these are types of strategies that I would use for my own portfolio. So for everyone has different reasons for why they want to remain invested in the markets. But if you have those needs to remain invested, here is one strategy that you can utilize to protect yourself. What about selling call verticals in the same ETF to finance the hedge rather than cover calls? You absolutely could. So obviously by selling call verticals or credit spreads, you're going to receive less income than if you were selling cover calls. I actually usually recommend selling cover calls on the individual names or the stocks that you own, because you actually get a bit of arbitrage there, because the individual stocks will actually give you a higher volatility than the cost to buy a hedge on the ETF. So you can actually get a little bit more extra on the cover calls if you sell them on the individual names that you hold, and then buy the ETF that most closely tracks your portfolio. So that is actually my recommended strategy for those of you that want to buy a hedge using an ETF, and then sell cover calls on the actual stocks that you own. And then you can always use our income tab. So let's say you own Intel as one of your stocks. You just type in Intel and we'll tell you exactly which cover calls to sell. You usually can gather more income by selling cover calls on the individual names than you can on the ETFs themselves. Steve's asking, to also offset hedge costs, could you not also sell covered puts on your long puts while the market is going down? Steve, could you possibly elaborate a little bit on that? What do you mean by sell covered puts? I'm not familiar with what you mean by covered put. If you just mean selling puts as a whole, absolutely, you can, but that kind of offsets your long puts. So I'm not sure that you would do that, because also if you're short a put, you don't want the market to go down. So it's kind of counterintuitive what you're trying to do. Selling calls is much more intuitive, because you don't think the market's going to go higher. That's why it makes sense to sell those calls. If you think the market's going to move lower, you usually don't want to sell puts. Any other questions regarding any of the things that I've gone over here today? I know this topic is a bit esoteric, and maybe not every single one of you may utilize this strategy. Is certainly maybe not right now, but the purpose of this webinar really is to educate so that anytime down the line, if you have any concerns about a market correction, maybe you don't see the same risks that I do today, but maybe you see different risks sometime down the line. This is designed to help you be prepared for that. So if, let's say, 6 months down the line, you think that some new thing is going to cause potentially downside risks in the market, then you should deploy this. So this is not telling you to go out and buy hedge now, but to be prepared for it. So whenever down the line you feel that the market's going to correct, you can use this as a tool to help you protect against that downside move in the markets. Any other questions regarding anything that I've gone over here today? Thank you very much for those of you that have said that you appreciate these webinars. Like I said, I'm always looking for feedback from these webinars in terms of what topics you guys want to hear. I do these webinars for you guys. So if there's any specific topics that you guys are looking to learn, please feel free to send me an email at info@optionsplay.com, and I'm happy to try to weave them into our webinar schedule. The month of July, we're going to be covering, this week was hedging, because I genuinely think that this is something that is on a lot of people's minds, and I think the polls here today show that. More than 80% of you say you're concerned about a correction. Next week, the webinar topic is going to be on earnings to kick off earnings season, because we have some pretty big names coming up in the next few weeks. So I want to make sure everyone's prepared for how to trade earnings season next week. And the next two webinars after that is I'm going to do one specifically on debit spreads and one specifically on credit spreads, because I've done a lot of webinars on the differences between credit versus debit, but I've gotten a lot more questions about the actual strategies within each one. So I actually want to spend a specific webinar on debit spreads and one on credit spreads, so that each one of you, doesn't matter whether you trade debit or credit, will have a specific webinar talking about the best practices of each specific strategy. So with that, I just want to thank everyone for taking the time out this afternoon. If there are no more questions, please look out for the recording that will be sent out to you in about half an hour with those slides. Please download those slides, because a lot of the things that I talked about in terms of best practices for hedging your portfolio are in those slides. Review them before you start placing a hedge in your portfolio, and make sure you play around with the tool. Try different hedges, try different expiration dates, try different strike prices, see how they perform in different scenarios. It's really important to understand how they perform in different scenarios and not just in one specific one, because chances are market doesn't exactly move exactly the way you expect it to. So being prepared is always the best thing to do when you're trying to hedge your portfolio. With that, I want to thank everyone for coming this afternoon, and I will see you guys next Thursday, where we're going to be going over talking about trading strategies around earnings, so that you can play earnings plays this upcoming month, which I think is going to be an interesting earnings season this quarter. So I hope everyone has a great afternoon, and I'll see you guys next week.